There it is.
Yeah, you got it.
Okay, and can you see my screen?
Yep. You got subtitles on.
Yeah.
Getting rid of the subtitles. Okay, so seller-funded buy downs, win-win for both buyers and sellers. That is our topic for today. And as you all know, interest rates have probably done, they've been going crazy. Haven't seen a time, at least, I share with folks, did my first loan helping a family in 1983 get a loan. And obviously that's a long time ago. And I don't think I remember ever a time in my lifetime when interest rates have doubled in such a short period of time. So what that's really ended up doing for us is giving us an opportunity to go out and start looking and seeing what else can we do? What have we done over time to, to grow or to address these issues, right? Over time, we've seen rising interest rates. We saw them in 2020, we saw them in 2018. So we've seen this before. And I will share with you that, if I can get my screen to move here with all the, we did this a long time ago. I've been doing seller buy downs permanent for a long time. There's actually 3 different types. We're only going to talk about 2 because no one's ever come back with the third one. So there's been a permanent buy down. There's been a 3-2-1 and a 2-1 buy down that's done through an escrow account. And there's been a 3-2-1 and a 2-1 that's been done through interest rates. So we're going to talk about these today. And obviously, if you don't know me, I did start doing my first loans, like I said earlier, in 1983 as the first family I helped do a loan. I've owned my own businesses. I've sold my own businesses. I've been involved in residential real estate. I've been involved in multifamily. We've owned, the largest we've had is 8 units. Starting in 2010, I started doing radio, home and finance radio show. It's been great because I get to talk to a lot of smart people and I get to learn a lot. And part of my passion is being able to then share that information. Now we're on 6 days a week. So we are constantly looking for a lot of content, but I get to talk to a lot of really smart people to share that information. So the question is, what is an interest rate buy down? So there are several different answers to that question. If I can get the screen to start pushing forward. Oh, I got someone else in the waiting room. So interest rate buy down, basically it's just paying money to the lender to buy down the interest rate. And we're going to talk about that in depth because we then need to understand that lenders, there's par rates. There are buy down rates where you actually can pay extra money. It's called discount points, or you can actually get a credit. We use that as a tool as well. So there are 2 types of interest rate buy downs. There's the permanent buy down, which is what I've been sharing for probably 6 months now. The permanent buy down is the only one of the 2 that actually will help a buyer qualify for a property because it's permanent. The other one is the temporary rate buy down. That one does not help a buyer qualify because it's not permanent. So let's talk about the permanent rate buy down first. So that's paying discount points to permanently buy down the interest rate. What are discount points? So discount points are fees paid to lower the interest rate for the life of the loan. They're done as a percentage rate of the loan. So an example of that would be if you have a purchase of $400,000, you've got a down payment of 10%, you've got a loan amount of $360,000. I'm just using a par rate of 7%. It's just easy. And actually, that's what the OBMMI rate was. The rate's actually locked at yesterday. So they actually did lock at 7.009, I think was the exact number. That gives you a payment of $2395.09, principal and interest only. So if you look on the top row of this chart here, you actually see that you've got 7%. There's no discount points. Doesn't help, so you've just got the straight 23.95. The next option, if my screen will move. That's why, is that? I guess whenever somebody goes into the waiting room, the screen stops moving. So at 6.875, you can pay $2,700 and you've got a $30 discount on your mortgage payment. Or 6.625, it's going to cost you $8,100 and it's going to save you $119. Now, we've been talking about different discount rates on the many of the programs that we've been doing, where we've actually been able to see as much as a 1.5% benefit to the rates. 1.5%. So that's a big benefit right there. And again, if you have any questions while we go through this, put them in the chat window. And hopefully either someone on our team will see it or I'll see them there. But you talk about 1.5%. I've seen some loans recently where we've saved $500 and $600 a month on the payments. Now, when you're doing that on a permanent buy down, that's where you're going to have that benefit going to helping people qualify for more property or that can fit their budget or fits their debt to income ratio. So what types of loans offer permanent buy downs? That's the big question, because we need to make sure we're involved in all of that. Almost every loan will have permanent interest rate buy down options. So you can do the conventional FHA, VA, USDA, jumbo, and the non-QM loans. That would be the bank statements and the DSCRs. All of those different loans will allow for the permanent buy down. The down payment assistance programs, those do not allow for permanent buy downs. So if you're involved in that, if that's one of the programs we need to be looking at, the permanent buy downs will not be available for that. The permanent interest rate the benefits here is the buyer qualifies at the discounted note rate. So even though par is 7, if we're able to do a buy down to 5.5, we're using 5.5 for qualification. The seller is the one that's going to provide the concession to pay the interest rate and discount points down at closing. That is a very, very important component of this, because if it's not done properly, this can actually blow up at the very end of the process, because it gets involved in high cost and predatory lending violations, a compliance violation that'll come up at the very end of the program. So it needs to be done early. Our team understands that. I've already had conversations with our underwriters, our capital markets folks. So we've got the runway clear for people to come in and get this done. The buyer is going to pay the reduced interest rate for the life of the loan. So if it's a 30-year loan, they're going to pay that reduced interest rate for that entire time. And again, when we do some of our samples of this, if you ever ask us for a total cost analysis, and I walk through the consumers right on that in a video, we're seeing that over 13 years, which I use 13 because that's how long we're keeping our properties right now. So over 13 years, we're seeing 120, 140. I saw one as much as $300,000 on a jumbo that was being saved over a 13-year period, the first 13 years of the buy down. So it's a very compelling reason. If you start looking at a 5.5% interest rate, even if rates drop, then I was with the head of the head economist of CAR a couple weeks ago at a luncheon, and they're predicting interest rates to go down, as most people are, most economists are. So if they go down, you may not even have to refinance, whereas when we're looking at the temporary buy downs, that is one of the functions that we talk about with a temporary interest rate buy down, because by definition, it's temporary. We're buying the interest down for a lower rate for 1 year or 2 years or 3 years. So there's all those programs, 3-2-1-2-1, and those are temporary. So when you're looking at that, they're reducing the payment, but we're not necessarily going to we don't have the note rate that's lower. So on that previous example, or let's go I'll give you a new example right here. Go back and using the same numbers, purchase price of 7%, down payment 10%, loan amount 360, par rate of 7. If we do a buy down, the note rate is still 7%. The buy down for that first for the first year, if it's being bought down to 2%, the buy down rate is at 5, and the principal and interest is at $19.32. You're saving $462 a month. But we have to qualify at the par rate, not at the bought down rate, because that's temporary. You can see in the second year, you're going to have that same par rate, but the bought down rate is 6%. The payment goes down to that $2,100, and now you're saving $236 a month. Again, that's only for a year. Then in years on the 2-1, you're going to have from years 3 to 30, you've got a 7% note rate. You're not buying it down at all because we're not using the permanent buy down. So you can see right there that the payment stays, the note's at 7, the payment stays at $23.95, and it's going to stay there for the remainder of the life of that loan. So there's no change. So what is the cost of the buy down? And again, this becomes a tricky calculation. It seems like it would be real simple. Say, okay, then my monthly subsidy is $462, multiply that times 12. You may not get exactly that when we go through and we put it into our system, because if you remember, we're doing the interest rate based on the principal amount of the loan, and that principal is dropping every month. So you've got a 5% for that first year, 6%, and then 7%. You've got $83.90 is your cost of what we're looking at on this particular process. Now, if you get a $10,000 lender credit, or seller credit, I mean, you're basically thinking about that. Now, 10,000, that's 2.5%. The average concessions or negotiated differences range anywhere from 2 to 6%. So if we take the average of that at 4% on that 400,000, you got 16,000. I'm going to probably use throughout most of the webinar today, $20,000. If the seller was going to discount 20,000, wouldn't you rather have asked them to discount 8,400 and keep the rest of that money in their pocket, because it's going to do a better job or more efficient for the process for the making it work for the buyer. So you can see where all these different numbers are coming from, and that 83.90 is right in there. So how does the temporary buy down work? So again, the buyer has to qualify at the note rate. They are not qualifying at the discounted rate. The seller has to provide the concession. Again, it must be in the contract properly, or else it can blow up based on the high cost and predatory lending. So if we're going to do this particular version, the 3-2-1 or the 2-1 buy down, it's important that whoever you're working with, and obviously we hope it's our team, you bring us in early so that we're able to work on this and get it done the right way, so you don't have a problem at the end. We don't like to get problems at the end. We do get some people that call us to bail them out at the end, and you know, we know how to do that as well, but we'd rather not have to do the bailout program. We don't like being bail bondsmen. We don't like being into the fire drills. This is the simplistic version of what's happening. What happens behind the scenes? So really what's happening is we're going to be collecting, I don't know why that does that when I put it on Do Not Disturb. So the way this is working in the behind the scenes, title is going to collect the seller concession at closing. So if we're doing on this temporary buy down, if we did that $8,400, title and the escrow company is going to collect that money. You've got to be dealing with a lender that understands how to escrow the money, because the note rate never changed. It was always at 7%. What we're doing is we're collecting the money in advance. So that's why someone's got to manage that money. So when the buyer sends in their payment, which is obviously going to be a little bit light for that first 3 or 2 or 1 year, the difference is going to be coming out of an escrow account. So the lender or the loan servicer has to be willing to accept that. Not every lender, not every loan servicer will actually do that. And it's got to, like I said, got to make that payment every month to get to the full amount. The note rate, like I said, is still whatever that rate was for the 30 years, or if it's an adjustable rate mortgage, whatever the fixed portion of that time period is. What other types of loans offer temporary buy downs? So basically, you've got to have the lender's got to be able to set this up. It's restricted by the lender. Not everybody wants to deal with it. We basically look at it. It's not quite as specialized, but when we do the rehab loans, it kind of works the same way. You've got to have a escrow account that's set up to handle those payouts on the rehab loans. Same concept here when we're doing the buy downs. Conventional loans, FHA loans, VA, USDA, those are all accepting these right now. Again, it depends on the investor, the lender, as to whether they'll do it. Once again, the housing loan, the down payment assistance programs, they do not offer these programs. So we just need to make sure we're watching what is in the right interest of the consumer. And I'll share with you, I've seen this many, many times where we get realtors that are trying to be way too granular on what they're doing in these things. And what I mean by granular is they want to know every last guideline, every last stipulation, and it ends up shooting them in the foot. And why do I say it shoots them in the foot? Because we're only talking about a very, very small segment of loans right here, right now. When you call us, or when your client calls us to get pre-approved, and we're dealing, say, with a down payment assistance, and we can't do a buy down with that, well, they might call for down payment assistance. We might switch them to something that's more advantageous to them. You may only know a half a dozen loans. I don't know real estate. I don't know what's on every street that like you know it. And I don't even want to get into that. I want to stay in my own lane. I stay in lending because that's what I understand. That's what I know. And it may turn out that, the down payment assistance it might be the right product. It might be that a interest rate buy down might be the right product. And it might be one of the other options that I'm going to talk to you about in just a couple of minutes might be the right product, because like I say, our team's been doing this for many, many years. We understand them. So we don't want you to try and to focus on really being granular. The idea for this webinar is for you to know, hey, there's temporary interest rate buy down programs. There's permanent interest rate buy down programs. There's 4 different programs that'll help a buyer qualify if their debt to income ratio is out of whack. Might even be more than that. As I mentioned before, the lender must structure the sales contract language of the mortgage loan correctly to avoid predatory lending laws. We've got to get it in there correctly. There's very specific wording that needs to be put in. Otherwise, like I say, you're going to be dealing with some serious problems down the road. We don't want you to have that. Seller concession options. So again, you've got a price reduction. You've got seller paid closing costs, seller paid discount points, seller paid temporary buy down. And one that no one really even talks about is, what about the mortgage insurance buy down? So we've talked about, you all know about price reductions. You get a lot more bang for your buck. And actually the seller is going to get more net out of the property by not doing a price reduction. I actually did a segment on radio today on 3 things that a seller should do before they ever think about a price reduction to attract more people, more realtors, and more activity on their real estate. So if you want to copy that, just let us know in chat and we'll get that to you. So we've talked about price reduction. You know about that. Seller paid closing costs. You know that the seller can do that to help out if there's a shortage of down payment money. That does not help the buyer qualify from a debt to income ratio. The seller pays the discount points for the permanent buy down. The seller pays the temporary buy down. And now we're going to talk about qualifying based on the seller paying for mortgage insurance. So most of us all know that there is borrower paid mortgage insurance. That's the most common. And I would venture to guess there's a lot of lenders that got into the business when it was really hot, lucrative, and easy that think, hey, there's only borrower paid mortgage insurance. That's the only thing that's available. But that's not true. There's also lender paid mortgage insurance. So the lender can pay that. And how's the lender do it? Increase the interest rates. So that's not going to help with the debt to income ratio, but it'll help if there is some problems with cash available. The reason I say it doesn't help with the debt to income ratio is because you just added more to the interest rate. I already shared with you that a lower interest rate is going to have more bang for the buck than anything else we can do. There is single premium mortgage insurance. It's basically buying out the mortgage insurance. And then one that very, very few people, if any, ever talk about, maybe don't even know about, is single premium, is the split premium mortgage insurance. So you've got a portion of the mortgage insurance is paid in a lump sum up front. And then there's a borrower paid monthly, which is a smaller number because you've already made a lump sum payment to start off with. That one there does help with the debt to income ratios, again, because you're using a smaller borrower paid. So the amount is a little different. So let's look at some of those and see if we can make that available to you or make it understandable. The seller paid mortgage insurance buyout, that is only available on conventional loans. Can't do that on FHA loans, doesn't work. The mortgage and single premium buyout, again, that's just one premium payment. Again, that's on conventional loans. It's based on risk-based pricing. So the credit score does have an effect on that mortgage on the mortgage insurance buyout. Let's get some examples of that now. Great credit mortgage insurance buyout, still going with the same example that I've been using, is $400,000 purchase price, $40,000 down payment, $360,000 loan amount, 7% interest rate, $23.95 is the principal and interest. Got great credit, $760. The monthly mortgage insurance on that is $51 on average. The single premium mortgage insurance to buy it out is $2,664. Not a lot of bang for your buck on that. So may not be such a great idea. Now let's take a look at the next one. If you've got average credit, let's do the same things again. $400,000 purchase price, $40,000 down payment. At waiting room here. $360,000 loan amount, 7% par rate, $23.95. But now let's look at what happens if there's a 680 FICO score. Okay, now you're looking at, on average, a monthly mortgage insurance of $123, and the buyout is $64.08. Now, remember I talked about earlier, we're thinking about a 5% price reduction. Well, that's $20,000. Would you rather help the buyer out with a $6,400 premium mortgage insurance buyout, or give them a $20,000 price concession and get $123 lower on the mortgage payment so they can actually afford to get into more property? So that's the average credit version. Let's take a look at what happens with bad credit. Purchase price, $400,000. All the same numbers here, same payment. But now you're looking at $620, which is about the lowest we see on conventional financing as far as a FICO score. But now take a look at this. The mortgage insurance is $252 a month. That's going to have an impact on the debt to income ratios. Single premium here is $11,376, still better than that $20,000 price concession, but it's obviously a lot of money right there. But this is another way of helping somebody get into a property where they may not have been able to otherwise because of their debt to income ratio. With higher interest rates now, that monthly mortgage insurance at $252 might price somebody out of the property. Now, if you have negotiated in there where you might even go to a higher purchase price, say you go in with a $420,000 purchase price, and now you've got $20,000 to spend. Maybe you use some of that money to buy out the mortgage insurance and some of it for a permanent buy down on that interest rate. Now, here's where the roadblocks come. I want you to be real careful of this. And again, there's a lot of speed bumps, red flags, snake bites, whatever you want to call it. You cannot get more seller concessions than allowed by the specific loan program. And every loan program has a different number. And I'll tell you this right off. I know these numbers, but almost every time when somebody calls me, I pull out a cheat sheet, and we can send one to you if you want. Just let us know you want it, of what the amounts are that are allowed. So on a conventional loan, it depends on what the down payment is. So if the down payment is less than 10%, you can only use 3% toward the closing costs from the seller paid. Again, it must be written up the right way or else it blows up. If there's 10 to 25%, we can get 6% on the seller concessions. And if more than 25% down payment, then we can go up to 9%. So that could be used for, think about that, on a $1 million property, that's $90,000 that could be used toward the buying down of the interest rate. The only highest I've seen done is like 56,000 recently. And in that instance, what the buyers did is they made an offer. Again, we go in and we're more than happy to sit down with the buyers agents and listing agents and sellers to explain all this. What ended up happening is we said, okay, let's take the property, let's increase the price by $55,000. We want you to use that $55,000 to help with the discount points. So it's a net neutral for the seller. Nothing comes out of their pocket, net neutral to them. But the buyers saving $400 or $500 a month in their payments, that's massive. So there's some of the numbers for that one. Another area where we do see a big snake bite is people forget that we have to be looking at what the occupancy type is. So in the one I just went over with you, that's for primary and second homes. If we're looking at an investment property, the limit is 2% is the maximum seller concession. Can't do anything more than that. On FHA, 6%. Here's another interesting one is VA. They've got some real interesting numbers in there as well. The closing costs and prepaid items are unlimited. Discount points are limited to 2%. So you can't go above that 2% in the discount points on VA. But the seller can go up to 4% paying off debts. So let's say the veteran is short on his debt to income ratio. Well, we can, if the concession is used to pay off, say, a car payment, that's going to certainly help the debt to income ratio. And that's totally allowable under the VA loan. As I say many, many times, the VA loan, in my opinion, best loan on the market, but that's only for people that actually earned it. It's the veterans out there. The USDA loan, that one's 6%. So again, if you want the chart, just let us know. We'll get it to you. So how does this benefit the seller? That's the key things that we want to know about, because the buyer, we know how it's going to benefit them. Seller credits help a home sell faster in a shifting market, maintain value of a neighborhood. Think about that. If everyone else is selling in the neighborhood at 360, and you're the listing agent that's getting 400, who do you think the next homeowner wants to talk to about listing their home? Price reductions are typically costlier to a seller than seller credits. I think I beat that one to death already. So you're going to want to do these concessions way before you ever think about doing a price reduction. And the new homeowner, they're going to want to talk to they're going to tell everybody about you, if you're able to do these kind of innovative things for them to help them get a house when every other lender is out there or a realtor is saying, hey, you can't do it. Now, which option is best for the buyer and for the seller? Let's take a look at some of these things here and see what they are. Original price option, purchase 400, again, 10% down, 360, 7% par, 23.95 is the payment, 0 seller concession. Seller agrees to a price reduction of $10,000 to $15,000 to get that lower payment. Let's take a look. Purchase price 385, down payment still 10%, 346, $89.82 on a seller concession of $15,000. Comparing options to a lower payment. So we've got the permanent buy down. The seller concession monthly savings is $119 for $10,000 in seller concession. On the temporary buy down, you got the monthly savings of $462 for an $83.90 concession. But again, remember, that did not help us for qualifying purposes. That just got us a lower payment in case the seller, in this time frame when buyers are having trouble making the payments anyway. So the seller drops the price, purchase price 385, 7%. Seller nets 385. Under the permanent buy down, the seller net is 389. So a little bit better there. And on the temporary buy down, the seller net is 391. So we do all these options. We lay all this out for the seller so that they can actually see these different things. Again, we have to work together on these things. That's why we work as a partnership. Our team, along with the buyer's agents, the listing agents, every case is unique. And again, as I mentioned, maybe one time we need to work on the mortgage insurance side. Maybe next time we need to work on a temporary buy down. Maybe we need to work on the permanent buy down. Every one we want to look at on an individual basis to make sure we understand what's going on. The lender and the agent need to work together on a case-by-case basis to figure out which option is best for which client. Must work with a lender partner that has experience and capacity to offer each of the options discussed, and make sure you present it to the seller, right? The sellers don't understand all this stuff. All they're looking at is saying, you want me to give a concession or you want me to increase the price? How does this affect my bottom line? That's what the seller really cares about, is what is their bottom line going to be like on these things? How much are they going to net out? And a lot of the options are really not going to have, a lot of the costs don't change, right? Title, escrow, regardless of whether you go with a permanent buy down or a temporary buy down or a mortgage insurance buyout, the costs don't change as far as title, escrow, appraisals, all those things. So what we're really just looking at is from the lending standpoint, and then we can work the rest of that in. We can actually even do some of these scenarios during the pre-approval process. And our team is on the line here. I know I saw that Josh is on there, Jody's on here, Sean, I think, is on here. Our team is ready to help in getting these things done as part of the pre-approval. Now, we like to go one step further if we're brought in early enough. We actually like to have the loan pre-underwritten. I had a question about a file. I sent a email off to our underwriter last night about 9 o'clock California time. And 5 o'clock this morning, when I logged back on, I had an answer to how we could solve the problem for this file, because we have direct access to a dedicated underwriter that can help us at any time. And she does a great job, because her focus is how do we get the loan done, not how do we reject a file. Obviously, we have to be compliant, but we want to make sure that it's all done the right way. Obviously, here's our contact information. You probably know that I am not a paid public speaker. So what we do is we want to be your lending partner. We want to interview for that job. The easiest way to find out how good our team will perform is simply by sending us over your next loan and let us get it pre-underwritten for your client. So you're able to go out and make same as cash offers. You'll know exactly what they're pre-approved for. and get out there in the marketplace and compete with those cash offers. I know there's not as many cash offers right now, but if interest rates go down, and I did this, I shared this with many of you, and if you didn't get a copy of it, top 5 reasons why you should buy now, and we can do that with your branding on it. People are waiting and saying, I want to wait to see if the prices drop or if interest rates drop. Well, the answer to that is real simple. 8 months ago, people were saying, I can't get my offers accepted. Well, is that what you want to wait for, is until you can't get your offers accepted again? Not sure that's really what we're looking to do. So now is the time for the buyers to get out there, work with an experienced team like us. We can talk about the needs or the requirements for the purchase contract when you find the right property, and get that contract written the right way so it flies right through the underwriting process. If there's anybody got any questions, feel free to unmute yourself, ask them, or put them in the chat window. That's our presentation on this subject. Can't believe I got everything with no questions. You can raise a virtual hand if you want to as well. No one has any questions. If you want a copy of this, just let us know. You can text us back. If you want a copy of that chart of concessions, let us know that as well. We've got a new webinar that I'm just finishing up on. It's credit score, understanding your credit scores and the home buying process. That'll be our next one that we'll come out with. So if there's no questions, oh wait, I think there's a couple of things in the chat. Robert Sully will send those out probably today or tomorrow. We'll send those flyers out. We'll get that out. Sue, Marnie, thanks. Appreciate you being here. Thanks, Jeff. Thanks for being here. Appreciate it. Good deal, folks. Appreciate y'all being here. We're going to sign out. Again, if you have questions, our team is available. I see him in the background. I see Sean is there. Josh has got his camera off, but he's with us. He's my right hand. And I think I saw that Jody was here before. Mindy was here. So we've got our team is available to help. Just make use of us. Have a great day. Talk to you soon. Martin, I'll get you that co-branded stuff today.